Hello, everyone, and thank you for joining us today. Today, we are very happy to have with us Michael Sweezy with Securian to go over long-term care. Long-term care, we're going to have some polls. Just want to make sure we're going to have some polls, some questions, hopefully, that you can answer. It's not mandatory, but we definitely would like your feedback doing this. We got a couple of individuals, a couple of advisors still joining us now, and we want to thank everyone for taking the opportunity to join us here today. Mike Sweezy, long-term care, is going to go over the sales, the opportunities, how to begin the process, and what questions to ask, and the different opportunities the long-term care presents. With that said, Mike, you should have co-host availabilities. You don't have to worry about anyone. I make sure that they get in as they come in, so you can just focus in on what you need to do there.
Sounds
perfect,
good, Lewis. And Lewis, if I could just get a quick confirmation, you should be able to see my screen. A PowerPoint.
Yes, sir.
Yep. Awesome. 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 And did that screw it up?
You look good. Look good.
You can still see the screen?
Yes, sir.
Awesome. Awesome. All right. So thanks for the intro, Lewis. Certainly appreciate it. And thanks everyone for joining us today. Like Lewis said, my name is Mike Sweezy. I'm a regional vice president at Securian Financial, specifically focusing on our linked benefits or asset-based LTC solution, which is called SecureCare. So what I thought that we'd be doing today, and what we are going to be doing today, is kind of walking through, we'll be chatting through the long-term care need throughout. There's not a particular section, but all of this is about the need to plan, the need to create those plans with your clients with their families, to help them better address and be better prepared for what lies ahead. And part of that is what I always like to call creating a plan, right? The plan is not necessarily the funding solution, but the plan itself is a very important factor and can lead to more impactful conversations regarding what is the funding solution for that plan. And then, of course, we'll wrap up today and we'll go through a little bit on the SecureCare policy, the SecureCare solution, and why that may be a great fit for some of your clients. And we'll chat through that a little bit. So I always like to start, however, especially in, I don't want to say times of turmoil, but things economically can be a little rocky here and there. So it's always worth pointing out, Securian Financial is a mutual company. We're the mutually held parent company of Minnesota Life Insurance Company. Some of you may not be familiar with Securian and be more so familiar with Minnesota Life. Think of it one and the same. It's just Securian is the mutually held parent to Minnesota Life. As you can see, very strong ratings across the board, high A's, A+ at AM Best, and then a Comdex of 96 out of 100. So an excellently, very powerfully, or very strong capitalized company. And we've been doing this for over 140 years, based in St. Paul, Minnesota. So anyway, with that being said, that tends to be enough on the ratings. But if anyone has any questions, I'm always happy to kick in a little bit more info on who we are as Securian. You guys have probably all seen some type of slide with this type of information on it, right? And it tends to be, hey, I'm going to tee up the need with my clients by telling them, 2 out of 3 of you are going to need it. Great. And when you need it, it's going to be very expensive, right? General amount, 50 to 100,000 on an annual basis. Great. That doesn't really get the point across, right? So we like to put it in context. And the way I like to start conversations like this is something as simple as, look, the likelihood of us needing is very, very high. And when we are going to need it is going to be very expensive, right? It's very expensive today, and that is only showing trends of continuing from a cost perspective. One thing I came across from a concern perspective is that this number, 88% of seniors prefer to receive their care at home. If you go back pre-pandemic, so go back 7, maybe 8 years ago, and I was doing similar conversations, that number of who would prefer to receive their care at home was in about that mid-70s, call it 75%. The pandemic did not do any favors for facility care, whether it's assisted living facilities, nursing facilities. We all kind of saw those pictures of grandma or grandpa, their hand on the window, looking through their window of their facility, of their, place in their facility at a grandchild, right? They did not come through unscathed through the pandemic. So this number of 88%, it's a very, very high percentage, but it's not an overly surprising percentage to me based on the conversations I have had. However, if you show this type of information to a client, it creates zero emotion. It causes them to take zero action. And all they have now is just a little bit of knowledge on some statistics around LTC, right? So what I'd like to do is kind of try to find a better way to go about doing the conversation to tee it up. And what I like to use is this. And Lewis, if I could just get a quick, or for someone, if I could get a quick nod or a yes that you are still seeing my screen, which is how to create a long-term care plan. Yes, awesome. Thank you, Mark. Appreciate that. All right, so instead of coming at it from just a purely single angle of, look, it's going to cost a lot and here's what I can do for you, show an illustration, and the client still has no idea why they're looking at this illustration. I am a big believer in the power of creating two separate conversations, right? Now you can mingle these together, but it's two separate steps. The first step is to help your clients actually create a long-term care plan. That plan is significantly different from that funding vehicle for that plan, right? It doesn't make a lot of sense to start with the funding vehicle for a plan they have not yet created, right? Even if we have an idea of what their plan is going to look like, let's still get something down on paper. Let's have conversations. Let's let our clients have conversations with their spouses, their spouse, their loved ones, their family members, those that will be impacted by their needing care. Let's make sure those conversations happen. This is a piece that we have built, and quite frankly, kind of you pull things together and put it all in one easy resource is really all we did for this. But what we wanted to do is provide a client-friendly, so this is obviously a consumer-facing piece that is product agnostic. There is no mention of insurance in here. This is simply an educational piece to help clients plan and to help financial professionals walk through that conversation with a little more confidence, right? That's one of the biggest hurdles that I hear is, I don't really know how to start this conversation, Mike. So what do I do? Well, great, here we go. So what we want to do is really start to answer the few main questions. Have you given thoughts to what long-term care looks like for you? Should you need care, right? I always like to say when you need care. When you need care, do you know what you want that to look like? When you're no longer able to care for yourself, who do you want providing that care? Where do you want that care provided? How engaged do you want your loved ones? Do you want them providing care? Do you want them just being a supervisor of care type of scenario? This helps walk through a lot of questions and answers for that, right? You'll see this list 4 critical questions. Today, we're going to touch on the first 2, all right? The second, numbers 3 and 4, they're great things to talk about, great things for your clients to plan about, but they're pretty self-explanatory, right? Getting into health needs, getting to wishes as far as medical directives, powers of attorneys, those types of items. But for our conversation today, number 1 and number 2 is really where kind of the bread and butter lies. Where do you want to live and where do you want to receive care? And then how are you going to pay for that? This should be customized for each client, just like every client's plan is going to be different. It's going to walk through some basic things that, call it pitfalls, call it, kind of bullet points on, okay, great. 88% want to be at the home. Your client may say, yeah, I'd like to be at home as long as possible. Great. Here are some things to pay attention to when we're talking about home care scenarios. Entry into the home, right? Wide doors and hallways, all these types of things. I'm not going to read this to you. I will make sure we get this to Lewis. We'll get it out to everyone. You can kind of flip through it. But the point is you'll have a guide that can help you along this process, right? It'll kind of give those steps from a client perspective, allow them to answer some questions. They may look at this and say, we didn't give a lot of thought to this at home. Our house is not suitable for this, right? So maybe they move, right? They downsize, they upgrade certain things, have to do some remodeling, or maybe they just decide a facility, an assisted living facility, for example, is the best bet for them. There's no wrong answer here. We're trying to get their wishes out, okay? But it's going to go through a lot of various scenarios on current home. How are you driving? How are you getting around? In other words, who's providing the day-to-day? Okay. Is it the spouse? Is it the grown adult children? Is there going to be a formal professional caregiver that's in the home day in and day out providing that, right? And even ask, would you like loved ones to be involved in your care? Yes or no? If it's yes, what do you want them to help with, right? Make sure they're aware of this, right? It seems so simple, but so many times as we have an aging population, that next generation that's going to be providing care, they don't know that it's going to be them, right? They think mom and dad may have a plan. In reality, maybe mom and dad did not have a plan, okay? So very critically important to walk through this with your clients and just get a really good understanding of what that care looks like for them, right? If I can't help myself, who's going to help me do it? What does that look like? Am I going to have to relocate geographically, or my kid's 600 miles away? You know, all those things come into play here, okay? Even provide some resources. You can look up resources. Elder care .acl.gov is a very popular one. Certainly local departments, but then it also talks about facility care a little bit. So housing and community care. The point of all this is obviously, one, to get a really good understanding of what your clients want in terms of their care, right? The second thing that this is going to get is it's going to be kind of a soft landing place for us to enter this conversation. How will you pay for care? Okay. Now, this conversation is in the end what takes us to the funding mechanism of care, right? Because that's one of the big concerns. We can lay out a great plan and let's say, hey, I want to stay at home as long as possible, or your client wants to be in their home as long as possible. They don't want to be a burden to their kids, which is the normal story that I hear. So they want professional caregivers. They want their kids to be involved, but not involved as care providers, right? They don't want to be doing the day-to-day. Great. Mr. and Mrs. Client, have you given any thought to what that might cost to receive care at home from that perspective? It's highly important to let them answer, right? Always important to let them answer. This is that dialogue, that back and forth, take notes, but it's also going to allow us to enter into this type of conversation, which is the cost of care conversation, okay? Now, I know I'm the Securian guy and I'm showing a Genworth website. Couple of reasons. One, we don't have one at Securian, so I use this one. And two, I spent about 10 years with Genworth, and the information provided on this site is fantastic. I encourage everyone to use some type of cost of care calculator. This is just one that I've had luck with, and it's pretty functional from a client perspective, right? So when we're having this cost of care conversation, they may be way off base. They may have no idea. They may be dead on, right? But it's important to have that starting point. So this is just for Florida. This is median care in the state of Florida, median cost, I should say, in the state of Florida. A home health aid is going to cost $4,700 a month today. Okay. We need to understand what that's based off of, right? Currently, this is based off of 44 hours a week, right? There's 168 hours in a week. So now we have to ask the question, and we start to educate on kind of some of these pitfalls and gaps, right? If there's 168 hours in a week, and we're only going to base a number off 44, who's caring for in the rest? Is it up to the spouse? Is it up to the family? If we make small changes here, and let's say it's 12 hours a day, 5 days a week, right? Well, now we're up to $6,500 for care today, just like that. That's per month. Okay, again, median cost. But we're not planning for care today. We're planning for care sometime in the future. Well, our average client at Securian is age 60. The average claim age, there really isn't an average claim age, but the bell curve spikes for claims between age 80 and in your low to mid 80s. So if I use 85, I can project ahead 25 years, and now we're up to $13,600 per month for projected cost of care. Mr. and Mrs. Client, what are your thoughts on that? How do you think you might pay for that? And again, let them answer. If this is shocking to them, it probably should be. And that's the desire, that's the reaction we're looking for, right? We're trying to get folks to become uneasy with what this might cost, to shift them off base enough where they're going to plan, not to scare them, right? The goal is not to scare them. So you understand your client better than anyone. If showing them $13,000 is going to be excessive, great. Let's back that hourly down. Let's have that conversation. because our goal is not to have to try to plan for all 13,000 in this example. It's to plan for something. We're trying to get folks to take action, to do some type of planning and creating some type of funding mechanism, right? Now, being that we just dragged this out by 25 years, we also have to answer the question of 3% growth rate. That's what this base is based upon. So this is 25 years at 3% inflation rate. Is that correct? Is that going to be close to what we are actually seeing? Well, it's a fair question. The 5-year average annual growth rate for a home health aide, so again, over the past 5 years, the average annual growth rate has been 5.92%, so just under 6%. Now, that does include, of course, a pandemic, right? But look, that's real life. That really happened. Could it happen again? Hopefully not, but maybe. The reality is baby boomers are turning 77 years old this year, right? 77-year-olds. Again, I mentioned claims don't begin to spike until early to mid 80s, call it 82 to 85. So we have 7 to 8 or so years before the baby boomers really begin to have a impact on our caregiving, on our caregivers, right, in our communities. We already have supply demand issues. That's the #1 cause of inflation in the healthcare industry, is lack of folks available for care. So what happens when the same baby boomer generation that we've been saying, 10,000 every day turns 65, that same generation is going to be turning 80, 85 and older. Now, it won't be 10,000, of course, but in large numbers, these folks are going to be needing help more and more and more, putting even more strain on our caregiving network. So the 3%, I tend to believe, is a pretty low value. If I change that to 5%, that's $22,000 per month. If this is not a conversation you're having already today with your clients, this is potentially the most shocking part of their retirement, because there are limited options in paying for this, right? Their spouse still has goals. They still have things they want to do and accomplish and things they want to pass along to children. This can deplete assets very, very quickly. That annual equivalent, so if you're interested, well over $250,000 per year at 60 hours a week of care. So your clients that have net worths of that 1 million, 2 million, maybe 5 million, that think they're living comfortably and they're going to be okay, that can be depleted very, very quickly in a real world scenario, right? And we're not even talking if they happen to spend a year in a nursing facility, which you'll see on the far right here, 391,000 potentially. These are massive numbers. But again, our goal is not to scare folks, right? If you're afraid to show someone a $22,000 future potential price tag, have the conversation, but don't show them 22,000, right? We can back this down to 3%, encourage them to plan. Even if some type of planning from a funding vehicle is better than nothing, right? Even if we can find a way to get $3,000, $4,000 of monthly benefit in 25 years, great, let's do that, right? We can always build upon things later, but let's get something started. So I like to do that to put things in perspective for clients and for them to realize this is not going to be a cheap endeavor for them. This particular page, we're back on this how to create a plan worksheet. I highly encourage you or encourage your clients to write these values down as you go through it with them based on the type of care that they foresee in their future, because when you write it down, it creates a realism to it, right? It's down on paper. Now, when I take it home and I look at it again, maybe 2 days later, show it to my spouse, show it to my grown kids, they're going to see these numbers. And now it's a conversation. Where did this come from? Right? We need to talk about this. This is crazy. So it can create some realism. It can lead to very positive conversations. But whatever number you land on, whether it's that $13,000 value, whether it's a $20,000 value, it doesn't really matter. The conversation is going to be the same, because the next question is going to be, how do you feel about that? Most folks are going to have some type of blown away, that's ridiculous, something to that effect. But then let's put some realism to it. Well, if this happened to you today and we're looking at today's cost, how would you pay for that? So if you needed care tomorrow, where would that come from? And we can use this, if you don't already have an idea of what their assets look like, we can use this part of the sheet to kind of take a bit of an inventory, right? folks will always target their checking account dollars, their savings account, those low yielding, highly liquid dollars, CDs, before they start to target their, of course, their retirement vehicles, and selling off homes and those types of things, right? So we're always looking to try and get some insight into what would they use first, because that is a potential funding source for the next step here, which is how do we pay for care, right? So we've created a plan for them. We've done some education, showed them some pitfalls, showed them some gaps. Hopefully had a few aha moments in there, or, things to think about. Gave them definitely probably some aha moments as it relates to the cost and projected cost of care. But now we get to educate them a little bit more. So in the next step is to educate them on the 3 ways to pay for care. And there's only 3, okay? The first one is government. So that could be Medicare, could be Medicaid, right? Could be some future state-funded LTC plan, right? We're hearing more and more about those. I know Lewis is obviously in Florida. I'm assuming several of you are as well. Florida does not have one on the docket. Washington State did one, kind of messed the entire industry up for a good number of months, but it doesn't cover much. It caps out at $36,000. Okay, so that could be a month or two, depending on what the cost is in the future, right? So we have to educate our clients on what Medicare and Medicaid are, what they are not, what they pay for, what they don't pay for, right? So that's very important. Most clients that you're going to be wanting sitting in front of do not want to end up on Medicaid, right? That is the goal, is to avoid Medicaid. There is nothing wrong with Medicaid. If your clients don't have the assets, that may be a plan, and there can be very specific Medicaid planning that can be done as it relates to their assets and where do we move things to help the family before going on Medicaid years prior. But Medicaid, of course, is spending down all those assets with limited future assets available, but they will pay for that care, okay, in their facility of choice. So there are really 2 primary ways to pay for care once we get through the government stuff, is going to be to either pay out of pocket, self-fund, or transfer the risk. Each one has pros and cons, right? That's not one be-all end-all for everyone. When we are self-funding, the biggest advantage to self-funding is nobody can tell me who I can or cannot pay, what I can or cannot pay for. And also, I don't have to worry about filling out an application during a phone interview, filing a claim when the time is right. We don't have to worry about any of that, right? What we do have to worry about, however, is reducing assets to a point where either they're gone and I run out of money, or they are reduced to the point where my surviving spouse may be impacted with their lifestyle. But the reality is, many people, some people respond to those, many people respond to the conversation of leverage, right? So if we're talking about $20,000 of care, great. Every dollar of care has got to come from somewhere. Now, when I need a dollar of care, I've got to take it from an asset. It's a dollar for dollar transaction, right? It's a neutral leverage situation. It's a wash. That's best case scenario in self-funding. Worst case scenario in self-funding is if either I have to sell an asset that's taxable, and now I'm spending $1.20 to get $1, right? So for every $20,000 of care at a 20% tax rate, I may need to take out $24,000, which is just making the situation worse and running through my assets that much faster. The power of leverage or lack of leverage in self-funding is why many folks with higher net worth, think 5 million plus, that could probably pay for it and be fine out of pocket, is still why they choose to transfer the risk in some way, shape, or form, or at least a larger percentage of that risk. And then that second option, or I should say third option, is going to be that risk transfer vehicle, right? Now, there's a lot of different types of risk transfer vehicles that we can choose. There are annuities, there are life insurance, there's life with long-term care riders, there's traditional LTC, there's chronic illness, there's all these different things, right? And I don't want to get you bogged down in those because that's not the conversation yet, right? We haven't talked about product at all with clients. All we're explaining to a client now is what transferring the risk does is it creates a positive leverage situation. So instead of dollar for dollar at best when I'm self-funding, I have a leveraged scenario where maybe every dollar of care that I need, maybe that only cost me 10 cents, 15 cents, maybe 20 cents, right? That's a much better sounding scenario than saying it's going to cost you $1 for dollar, or it's going to cost you more than that dollar, right? So that leverage scenario is really where we make hay in that risk transfer vehicle, okay? And then it comes to the conversation with your client to something to the effect of, look, what I really like to do with my clients is explore this risk transfer for them, because you have to qualify for this, right? Anytime you're doing a leverage scenario and you're using other people's money, you have to qualify for that. And in this case, you're going to qualify based on your health. The healthier you are, the more leverage we can get. In other words, the cheaper your benefits are going to be. And if you're less healthy, it doesn't mean we can't do something. It just might mean the leverage is less. That's it. So let me ask you 2 medical questions, and I'll put together something for you and we'll see if that's a suitable fit for you. How's that sound? Most people are going to be like, okay, that's great. Let's do it. Those 2 medical questions are, the first one, what are you currently being treated for, including medications, right? If you're in physical therapy, that's important, need to know. If you're currently taking a blood pressure pill, that's important, need to know. It's not necessarily knockouts, but they're important and we need to know, right? Because what we're trying to do is put together a quick quote for not only Securian, but for other carriers as well, to see where's the best bet, the best opportunity for approval to maximize leverage for this client, okay? There is nothing more challenging in this environment. You get to someone, you show them, you walk them through all this, you show them an illustration, everything looks great, they're excited, they do the phone interview, they get declined. Well, if they were looking at, just as an example, a 10-pay, $10,000 a year, and that was turning that total of $100,000 into $900,000 of total pool at age 85, that's massive leverage, right? 9 times leverage on that premium. But if we have to try to walk that back, and if their health dictates that the only thing that we can get them qualified for may be an annuity with a doubler or a tripler, so now their total benefit pool is 200,000 or 300,000, that is a very, very challenging sell. So I highly encourage you to ask these 2 medical questions, right? What are you currently being treated for, including meds? And what have you been treated for in the past? Okay, especially the past 5 to 7 years. We want to get out all cancers. I don't care how old it is. We want to get out all heart issues. I don't care how old it is. Get the big stuff. All of those come into play, okay? Not every client, unfortunately, is, they're healthy except, right? We always get the except. That's always the joke in Lewis and I's world. They're super healthy except. So anyway, ask those 2 questions. We have quick quotabilities. Every carrier out there does. We can give a thumbs up or thumbs down right out of the gate if this is a good application for us or not, and make sure we show the option with the best leverage for the client. All right. I'm going to go back to this. And if I could get one more time, make sure you guys are seeing a PowerPoint slide again. Yeah. All right. I'm getting a shake of the head from Mark, so we're going to see we're good. All right. So when it comes time to put that presentation together, now we're getting into product. But the great part is we haven't talked any product at all. You don't have to try to think on your feet and know all the specs about a product. You can quick quote it, put it together, and between Lewis, myself, any other wholesaler out there would be more than willing to train you up on here's how we do the presentation for SecureCare, right? So SecureCare at its core is what we call a live, die, or quit solution, okay? Couple things to start out of the gate. Everything in our illustration is fully guaranteed, 100% guaranteed. There are no moving parts inside our illustration that cannot come true. The only thing we don't know is at what age will they need to use the benefits and which benefits will they use, right? Will they use, you see it here, the LTC benefits. So that's guarantee number 1 as we lay this out. Their long-term benefits, completely guaranteed. All inflation is guaranteed. You cannot lose inflation. You get your full monthly max every single month, okay? If I don't need care and I pass away, either without needing any care or minimal care, there's always going to be a death benefit that is at least, well, generally speaking, it's equal to premium or higher. So there's always that ability to make whole, right? That's a big concern for clients is, does the big bad insurance company keep my premium if I pass away without needing care? No, we pay that death benefit. It's listed in the illustration. They'll know exactly what they're getting into well before they get into anything, right? And technically, they have money back options. They have return of premium options. There's 3 of them in our contract. You choose these at application. I can simplify this for you a lot. in my view, there's two viable options, okay? The first one is a vested 100% return of premium structure. That's going to maximize the client flexibility. They can walk away on our single pays at the start of policy year 6. So 100% return of premium at the start of policy year 6. If they're choosing any of our multi-year premium schedules, which are 5-year, 7, 10, and 15, their 100% return of premium would be the year after their final premium payment. So a 10 pay vests at the start of year 11, right? So that builds up that flexibility, the ability to walk away from a contract. Less than 2% of folks have ever walked away using return of premium to walk away from these types of policies, which is why we see about 10% or so actually take that full return of premium option, because we do give up, it has cost, we do give up some of those LTC benefits. And on the other hand, we're going to have what we call LTC Boost. LTC Boost is going to maximize your long-term care benefits, and your return of premium is nothing more than your guaranteed cash value, okay? So for those clients that are comfortable, they want to maximize those LTC benefits and aren't worried about walking away from the policy and surrendering it, that's going to be their best bet. There's 3, I talked about 2. There is one that's in the middle. It's a 75%. Very few people ever use it. If any, we get about 10% on the vested and about 90% on the LTC Boost, okay? And then this 4th component here is really a peace of mind type of scenario for the clients, right? While the return of premium trigger is not likely at all to be used by clients, even those that have it, what does come up much more frequently is the ability to stop paying premiums in the future on those ongoing premium plans, right? So think a 10 pay or a 15 pay where clients are paying larger annual premiums over an extended period of time. What our guaranteed reduced paid up benefits does is it actually puts a chart inside the illustration. It's plain as day. It's on page 3, I believe it is. And it'll be called guarantee number 4. You can quit paying premiums and take your reduced paid up benefits, which are all fully guaranteed. You can actually tell your client, if you pay through 7 years, as an example, here's your death benefit and here are your long-term care benefits. One of the very neat kickers to it is any inflation will continue to inflate those LTC benefits even after the client stopped paying premiums. So it's a huge peace of mind, huge flexibility for the client, and it's a great sales positioning from the financial professional's perspective. All right, instead of going through each one of these check items here as a different slide, I like to just kind of hit it all as one, right? Since a lot of this we've already talked about. The first one on here, however, we have not. So we pay our long-term care benefits through a cash indemnity LTC benefit model. What cash indemnity means is every single month while the client is on claim, and to qualify for claim, the nuts and bolts are needing substantial assistance with 2 or more activities of daily living, or needing assistance due to a cognitive impairment, a severe cognitive impairment, okay? So your 2 ADLs are cognitively impaired, you're receiving benefits. We are going to pay every single month up to the full maximum monthly benefit straight to the client, right? Straight to the policy owner. Those benefits can be used for any type of care provider, any type of situation. They can be saved, they can be spent. It is completely up to their discretion and the family's discretion on who and how those are spent. Now, the other option that's in the out in the market is the reimbursement plans. I will say this, cash indemnity plans can pay everything that a reimbursement plan can pay for, right? We can assign benefits straight to a facility. We can pay only what they're wanting. We can do all of that. But what we are trying to do is give the clients the opportunity to achieve the leverage that's illustrated. The only way to do that is to take every single dime out of this policy as soon as it's available, right? So if you have a $10,000 monthly benefit and early in your care needs, you're only spending $7,000, maybe it's part-time care at home, whatever the situation might be, a reimbursement plan is only going to reimburse $7,000. You just missed out on $3,000. That is moved to the back end of the policy. You're going to have to live longer than the original benefit period was, right? So if you had a 6-year benefit period, you're going to have to live at least a month into year 7 while on care in order to get those $3,000 back. With cash indemnity, take the full $10,000 that you have available, spend the 7, save the 3,000, because I can guarantee you at some point, that $7,000 cost is going to be up to 8,000, 9,000, 12,000, 15,000, right? LTC costs are not stagnant. They will continue to rise. So you can create basically an additional savings account vehicle to help offset those additional costs when they're above your monthly benefit. All right. Guaranteed death benefit, we talked about that. No matter how much or how little of your LTC benefits you use, there will always be a tax-free death benefit paid to your beneficiaries. Guaranteed reduced paid up benefits, we hit on that. We talked about the premium options. You see those there. In addition to those premium options, we do a lot of 1035 exchanges. So make sure as you're talking through funding mechanisms, look at old life insurance policies that may have cash values that we can 1035 to jumpstart policies. They don't have to be huge amounts, right? We can do a 1035, a smaller 1035, let's say $15,000. So we can do a 1035 in year 1, and then starting in year 2, we can do an ongoing annual premium of say $7,000 or $8,000, right? So we can kind of mix and match a little bit. We can also add in cash lump sum to that. Doesn't have to be a $50,000 or $100,000 single premium, right? We can do a $15,000 1035. Maybe it's another $12,000 cash lump sum, and then maybe it's just a $5,000 ongoing annual premium after that. So there's a lot of different ways, as long as premium from years 2 through the end are equal in level. That's the biggest thing we need to be aware of. Inflation, we got 4 inflation options, technically 5 if you include no inflation as an option, which it is. 3% simple and compound, 5% simple and compound. Again, I'll streamline it for you. Almost 80% of all of our cases are issued with 3% compound. The rest is a mix of 5% simple, as well as no inflation for older clients. Older clients meaning 70, 71 plus. Our max issue age is 75. Okay, 5% compound is very expensive, so it really hits away at the death benefit. It can sometimes make sense for younger clients, but we don't see it that often because of the cost. Tax deductibility. So this is always a fun one. I'm not going to dive deep into this one today, just from time constraints. We do have the ability to deduct long-term care premiums. It works the exact same way as deducting traditional long-term care premiums does. The only difference is on our illustration, we break out the life insurance premium, which is not deductible, from all of the long-term care premiums, which may be deductible, right? It is not a great story for an individual, okay? It is a much better story for business owners. So if you work with business owners and they are interested in long-term care planning, we should probably chat and dive into what that world looks like and how those deductions can be taken advantage of, okay? International benefits. Our international benefits are absolutely fantastic. Again, if your clients are in that, the clients will either have a potential likelihood of retiring overseas, is the way I look at it, or they won't. So if you're talking with a client that may and doing some LTC planning, we leave the policy for the most part intact. The only thing we change is we reduce the max monthly benefit by 50%, which essentially doubles the benefit duration, right? So there's no change in the cash indemnity. There's no change to the total benefit pool. They just get less on a monthly basis for a longer period of time. And then we do have a 90 calendar day elimination period for all care types, whether it's home care, facility care, 90 calendar day elimination period. 2 key things to that. During that 90 days, the client does have access to, with no wait, up to $5,000 for home modifications and up to $1,000 for caregiver training, okay? In addition, the 90-day clock, if you will, starts when we can best determine the client was certified as chronically ill, okay? So easiest example I can do is if someone has a stroke, okay? Someone has a stroke, tend to be hospitalized for a point in time, and let's say that stroke was on May 1st. Obviously, the family is busy tending to that individual. They may take, it may be 30 days, maybe 60 days before they file claims paperwork, okay? And let's say it was July 1 before that claim was approved. That means they're already 60 days into their 90-day elimination period in that example, okay? So it's very common that clients have already eaten through a nice chunk of their elimination period once the claim has been filed and approved. And then, of course, there are terminal illness benefits included in this. What we want to make sure with SecureCare is that there are multiple ways that clients can receive benefits, whether it's LTC benefits, the main reason they're buying it, the death benefits, which is a secondary reason they're buying it to make sure that their investment is covered or their premium is covered. There's also terminal illness benefits. That is 12 months of life expectancy or less, does not mean you're chronically ill. You can accelerate a very large portion of the death benefit for early use. Now, I just want to go through one quick slide here on the competitive comparison. I don't like showing a lot of these because they can be kind of cherry picked, if you will, to really come into our, to be what we want it to be. However, Securian on SecureCare had a massive 25% price improvement. So a benefit increase or premium decrease, however you want to look at it, back in March. This is the current kind of live pricing as you see. This is based on a 60-year-old male starting with $5,000 monthly benefit, solving for premium here, with 6-year benefit period using our LTC boost to maximize that LTC benefit with 3% compound inflation. You can compare kind of across with the other 3 primary carriers in the asset-based world and see how we compare in single pay 5, 7, 10, and 15. Obviously, it looks really, really good, right? So couple that with the flexibility we provide. It is a great opportunity from a SecureCare perspective, and we're seeing a lot of business because of the pricing, because of the flexibility in the market space today. So, but I don't like to go through a whole bunch of those. Last topic I'll touch on. Application underwriting process, right? So application comes in, that can come in through paper app or e-app. All right, so we always encourage e-app. It is about 2 to 3 days faster if you're able to do the e-app. We do not do parameds. We do not do exams. We do not require fluids. We will do a phone interview that we schedule with the client. That phone interview will take about an hour. For clients 56 and older, there will be a cognitive portion to that phone interview, generally a word recall. And we will also have the ability to order physician statements, APS records for cause only. There is no age or amount requirement for us to order records. It is simply to try to get to a yes, to try to get to that thumbs up. A great example, type 2 diabetes. We can insure type 2 diabetics, but history and control is always a big thing. So depending on the phone interview goes, it is pretty common that we will order records on diabetes cases. AFib is another common one. Where we will order records, but we certainly can insure those cases, okay? We will not order records if it's gonna be a decline no matter what the records say. We don't wanna waste that time, yours or the client's. We order those currently, we're trending at right about 28% records ordered. And we do have about a 60 to 70% approval rating once records have been ordered, okay? The last thing, really substance that I'll share with you today, I encourage you to talk to your clients to start these planning conversations today. The reason I say today is because yesterday was not an option anymore. And tomorrow, we are all one doctor's visit away from being uninsurable, right? As we age, we tend to not get healthier. And you can see from this chart, this is not SecureCare statistics. This is LTC industry-wide stats. As we approach our 70s, those approval ratings go down rather dramatically, right? 70 plus is kind of a 50-50 shot. But if you can start talking to clients in their upper 50s, lower 60s, that's a really great spot to start having those conversations, if not younger, right? I'm a big fan of using life changes, life events to really tee up these conversations. A great one for here for many folks is, hey, kids graduated college, what's next, right? They tend to be in that 50 to 60-ish age range. Kids are off the payroll. We've got some extra assets maybe. Now it's time to really hone in on that retirement plan, which should include how are we going to plan for this LTC component, right? So last thing, we have some great resources out there, a lot of great resources. I will make sure that you guys all have access to this LTC planning piece. But you can also check out securian.com/SecureCare. That's the overwhelming majority of our client materials, agent materials, client brochures, all that fun stuff can be found there, along with videos, quick little sales ideas, quick hit type things. And with that being said, I will make sure everybody reads all the disclosures as I turn it back over to Lewis.
Thank you, Mike. Appreciate the time that you've taken to spend with us on LTC planning. A couple of questions that came over the chat. Just wanted to make sure that we covered them. What's the max benefit period on SecureCare?
Oh, great question. Yeah, so the benefit periods will be between 4 and 8 years.
Okay. And of course, that has a lot to do with what their benefit pool is and the exhaustion of that, correct?
That's correct. Yeah. So a 4-year benefit period is going to have a higher monthly, if we're looking at the same client, right? A higher monthly amount, but a lower overall total pool than if I were to compare to a 8-year benefit period, which would have a lower monthly amount, but a much higher pool. Real world usage, we do see a lot of husband and wives kind of honing in on the specifics, right? So rule of thumb, women live longer than men, period, but also live longer on claim than men do on claim, right? So it's not uncommon for us to see a female with an 8-year benefit period to maximize that duration, right? Get more coverage for a longer period of time. While the husband, who may figure, especially when you take into account family history, they may take that 4-year benefit period, try to really increase that monthly amount, knowing, hey, if no male in my, look at, what was the longevity when folks started to become impaired in your family, right? That's always a great tool. If nobody in your family as a male, lived past the age of 78, and great, you're planning and you're age 60, okay, you know what? Probably don't need an 8-year benefit period. 4 may be suitable if you're comfortable with that. Front loaded at the 4-year, let my wife take the 8-year, and between us, we're probably going to be really well covered.
Gotcha. Are there any issues with California with SecureCare?
Yeah, the biggest issue is we are not improved in California. So that's a great question. So California, New York, and Montana do not have SecureCare available at all. There's no product available for SecureCare. The price change, every other state does have some version of SecureCare available. We are working through updating that and getting the new rates in some states. But there's only a handful. So if you're illustrating something and see something off the wall, just let me know. And it's more than likely an old UL product, or I should say our old UL product, or it's on SecureCare 3, but the old rates. Closest state that's impacted just geographically to Florida is South Carolina, is on the old SecureCare 3 rates still. But we're working on it, trying to get them all out.
Ronald, in your question, California, the SecureCare product is not approved in California, but I'm sure if you had an opportunity to speak with Mark, there are different products that are approved in California that may be suitable for you and your clients. There.
And we're working on it. It's just California is very slow.
California is California.
And they required some things that we have to build out. So we're going through that process. So
great. So hopefully, if there's anyone that has any questions, you can throw them in the chat box and or unmute yourself and just ask. We'll keep that open for about 30 seconds or so and see if there's any questions out there. Looks like you did a really awesome job, Michael. Appreciate it. Thank you very much. Again, a couple of notes to take away. SecureCare with Securian, Minnesota Life, a very strong carrier, over 140 plus years in the business. And I'm sure we all know someone, friend, family, clients that has been impacted by long-term care. So there's definitely a conversation that we should be having. And hopefully we've given you some tools to help start that conversation with your clients and hopefully help your clients out with that, whether you're insuring the entire amount or, in my opinion, anything is of value to your clients. Mark, did you have anything to say before we end today's session? Nope, Mark is quiet in the corner there. All right, so appreciate the opportunity to speak with everyone today. We look forward to working with you guys in the future. If you have any cases, questions, concerns, what have you, please give us a call and we'll be more than happy to work with you. Mike, once again, thank you very much for your time.
Thank you, Lewis. Thanks, everyone.
And we
Appreciate
look
it.
forward to the next one. Thank you. Thank you guys very, very much.